Good morning, everybody, and welcome to the Daily Energy Markets podcast. We have Brent crude oil essentially unchanged or little changed in the Asian trade this morning, up a few pennies at $62.44. We're seeing essentially Brent since the sort of shock drop of last Friday, off of that sort of $65 happy place, is finding some sort of new range in the low 60s. Let's go to New York this morning or this night, I suppose. Mike McGlone, senior commodity strategist at Bloomberg Intelligence. Mike, what's your sense of what the oil markets, the commodity markets, perhaps more broadly, are most focused on? I mean, we've got the China war, trade war with the US on one side of your headline. On the other, we've got the Fed chairman the signaling or trying to soften the market up for another cut. Your thoughts on where the sort of main North Star is at the moment for commodities?
Well, I'm a little bit south of New York. I'm in Miami. And I
Okay.
think for the broad commodity market, most notably the elastic commodities, crude oil, the grains, a lot of what you mentioned is somewhat noise. It's a macro, bigger picture. That's the pressure factor on prices from going up too much to the peak in 2022. Now they're all heading towards that low price cure. And like, for instance, this year's low in WTI is $55 a barrel. That's basically the average price from 2019, about the US break even cost. And it's just a question of how much lower we go to get below that break even cost, maybe stay below it to reset the excesses of supply versus demand. So the key thing about crude oil, it's not alone. Grains have the same thing. Corn, soybeans, wheat are all being pressured lower. Even natural gas is a big problem. Last year was a colder than a normal winter, and the market's priced for a second colder than normal winter amidst global warming. So that's a bit dicey. But overall, the geopolitics have seem to be alleviated. Right now, it's the macro, bigger picture. And the key thing in the broad commodity market is metals versus everything else. I mentioned the elastic commodities heading lower. I think crude oil still has more weakness ahead, and gold leading the metals up, and copper kind of stuck in the middle there. And that's what we think from a broad commodity standpoint. Gold going up and crude oil going down. Certainly, gold going up at this velocity, and crude going down is a global recessionary trajectory. And the key thing holding everything up now is that U.S. stock market.
Jamie Ingram, managing editor at Middle East Economic Survey. Jamie, I mean, in all the noise of the last week, as I mentioned, Jay Powell yesterday comments about the outlook for the Fed. We've got the China-US trade war and the uncertainty from a sense of where the US economy may be going. Jay Powell signaling weaker employment data. But the biggest headline in the world still is and has been for the last week the ceasefire in Gaza. So it's hard to, in some ways, to understand or to really parse these things apart. The ceasefire in Gaza, how significant event that is for the Middle East region, how significant event it is indeed for the energy markets, for the oil producing countries, which all essentially border the Middle East turbulence. Your thoughts on the events in Gaza and their connectivity for the energy markets?
Morning, Sean. Good to be with you today. Yeah, a couple of things to unpack there. As you say, there's two clear separate questions there. One is, how does Gaza fit into the broader Middle East issue? How does it fit? Secondly, how does it fit into the energy markets? If we touch on the first one, to start with, clearly the broader Palestine issue has been at the root of a lot of the instability in the Middle East for a number of decades now. So there is hope that this is a tentative first step towards emerging from that troublesome period within the region. But we are very much at early stages. Yeah. You know, Palestine has obviously been the site where a lot of proxy issues have been played out. Iran has played a major role in Gaza. That's been rolled back somewhat now. But I think when it comes to the energy markets in particular, there has been a lot of commentary about how remarkably risk tolerant energy markets have been over the last 2 years in particular. When it comes to the Palestine issue, to Gaza, the the key inflection point, I think, going forward will be what will the Houthi reaction to all of this be? That's really been the only issue here where Gaza precisely has had a clear impact on energy markets. It hasn't hit production and supply from anywhere, but it has had a significant impact on trade routes, adding a lot of friction into the markets in that route as a result of the Houthi blockade in the Red Sea. No indications at the moment as to whether the Houthis are going to ease off on that. My suspicion is that they've had a lot of global wins as a result of their action, and they'll be looking for some excuse as to why they're allowed to continue to harass maritime traffic in the region, despite moves towards a possible lasting peace within Gaza. So for me, the Houthis are really the key issue to watch for on global energy markets. But Gaza as a totality is unlikely to have a significant impact on prices going forward, I think.
Daniel Richards, MENA economist at Emirates MBD here in Dubai. Daniel, looking at these sort of big picture items that we sort of drill down into the local neighborhood, we're still at $60 to $65 Brent for most countries. The region, these are well below fiscal break-even, budget break-even levels. Your thoughts on the trajectory of this oil price and its consequence then for the regional countries, in the sense that Saudi Arabia's ability to do certain things at $60 versus $80, it has impact on spending and so forth. But if you could give us an update on the fiscal stress it's putting the regional countries under.
Yeah, sure. A bit of a mixed story, I guess. For UAE, we still expect a pretty sizable budget surplus, and even with this lower price trajectory, that is still in play. They're in a pretty solid fiscal space, which is, of course, as you mentioned, in contrast to what we're seeing in Saudi Arabia. They have come out in the last couple of weeks and adjusted their fiscal deficit projection for this year and next. They now see around 5.5%, which has brought them in line with ourselves. They had been saying 2.3% of GDP, which we always thought was highly unlikely, to be honest. I think their latest projections put them more in a realistic space. But in the near term, at least, they appear committed to spending. They have committed to these budget deficits. They have come back to a market repeatedly throughout the year. And they have a number of projects already in play, which they are committed to, like around the major international events. So in the near term, we remain pretty bullish with regards to Saudi Arabia. They are continuing to spend. There is a lot going on. All the near-term indicators are solid. But of course, the longer this lower oil price environment goes on, which is expected to last, and the higher production probably won't compensate for that entirely or even close, then the longer term projects do come more into question, and some of the more headline generating activity, the line, etc., will come under greater scrutiny. We have talked about recalibration, and we'd expect that to continue. But
for those who don't know what the line is, if I heard you correctly, the line is a 300-kilometer long building. I'm not sure that's still on the drawing boards, is it? Or that hasn't been abandoned yet?
A dot, if anything, I think, is what the likely scenario is.
It's no longer a line, it's a dot. But just, Daniel, to follow up on a kind of more serious point in this sort of potential nexus, is due to the lower oil price and whether maybe even regardless of, the regional countries here, Saudi Arabia at the front of the queue and the UAE as well, have been turning increasingly to the global debt markets. And it is seen as a major source of financing of big projects and diversifying away from dependency on oil revenue and so forth. So the regional instability, the Gaza sort of nightmare, as well as potential war between Israel and Iran and so forth, all of these things are not good for your credit rating, are not good for borrowing hundreds of billions of dollars on global debt markets. Maybe just speak a little bit to that nexus, if you would.
Yeah, I mean, they're not good, but I'd agree to a point that Jamie was making, that the impact generally hasn't been huge from the Gaza or even the Iran conflict that we saw briefly in June. There's a little bit of impact on the PMI surveys, for instance, for June and July for the UAE, but you look at visitor numbers, whether that is Saudi or UAE or even Egypt, which saw record visitors last year despite the conflict across the border in Gaza. You look at all the near-term growth indicators, they've been pretty solid. I think there's kind of a perception that broadly that conflict was one that was self-contained. I don't think there's ever any expectation of a kind of wider conflagration like 73, 67, or the historical conflicts we've had in the past. I think it was seen very much as a self-contained issue, notwithstanding the brief flare-out with Iran. But even that as well, I don't think, even with the Qatar strike, there was ever really a high expectation that that was going to lead into a wider regional conflict. So obviously, any conflict on borders isn't a positive thing, but I think that really the impact on credit ratings would be fairly marginal.
Very much interesting. Mike, looking at where this all goes going forward now into the fourth quarter, this is the question. We've got this sort of macro backdrop of the geopolitics, war, no war. Ultimately, the oil market is moving forward to its own drum, so to speak. And that is one where is supply demand softening and yet supply increasing. We got OPEC Plus telling us quite clearly what they're going to do. The question mark then is over non-OPEC Plus and the US in particular, given the world's largest oil producing country. Where is the outlook for more supply coming from there, more supply coming from the Americas to really challenge this this current framework of oil prices holding in the 60s?
Well, the latest headlines are exactly what you'd expect as prices decline. You're seeing declines in rig counts and shale production. And it's because of one key factor: prices are going lower. That's the key thing that a lot of strategists underestimated when prices went above $100 a barrel. It just brought on that supply. And now the elasticity of lower prices is reducing the supply. The thing is, every time we get those little spikes for geopolitical reasons, people sell forward. So that spike so far, the high this year has been about 80. We're running in Brent running around 60. And yeah, supply is going to come off, but it's more global. It's just a perfect storm for lower prices. The key thing I like to point out is, last 20 years, WTI has always bottomed around $40 a barrel, around there, at least two or three times. It's going there again. And I don't see what stops it other than some kind of miracle. And
how does that impact that
up
industry? I mean, given that the energy industry in America is a pretty significant industry with a lot of political influence, at least they thought they had, where does that industry go at this time? Are they happy at $60?
Well, I'm not so much happy, but they have a president completely emboldened with he has their back. He wants lower prices. He's getting it. He wants lower interest rates. He's getting it. And so far, that's the trajectory. And the key thing that he's missing, I think, is he might have the timing of Herbert Hoover as far as how expensive the U.S. stock market is. That has to stay elevated. So you saw what happened on Friday. Stock market dropped around 3%. Everything declined, most notably crude oil dropped more. And that's why that everything's kind of tilting on that. And we just recently had a situation where, volatility, stock market volatility just dropped to the lowest in like on a 90-day basis in 5 years, just a month ago, or just a few weeks ago. So we're all teetering on cliff's edge. And the key thing is what gets crude oil to stay up. I know it can make it go lower because that's the trajectory. The key thing, it's not alone. It's most of the commodities are in that space with the notable exception of the metals.
Jamie, where does OPEC Plus would go at all this? Of course, we've had this, again, news somewhat buried in the headlines behind the ceasefire news, but OPEC Plus did announce their intention to continue their increased policy into October, or into what's next month, November, and so that's sort of 8 months now of steady drip increases. Is there any end to that? At some point, do they run out of extra capacity to bring on? I mean, I know they have it on paper, but where do you think OPEC Plus goes with this $60, $62 Brent?
Well, I think that speaking to some of the member countries, everybody is well aware that we're entering what they like to call the seasonal demand decline. We're entering the soft period over winter. So even those within OPEC Plus, they are fully expecting prices may well continue to soften somewhat further. I was at the Energy Intelligence Forum in London this week. I'd say there was a very strong consensus that yes, prices will continue to soften in the short term, possibly even dropping into the 50s for Brent in early 2026. But there was also a very strong consensus, and this is across the board, whether we're talking about trading firms, Western energy majors, NOCs, that there is a bit of a crunch point coming. That might not be until late 2026, might not even be until 2027. But the lack of non-OPEC plus supply is going to start impacting markets in the relatively near future, not the short term, but the medium term. So I think that the calculation that OPEC plus is making at the moment is yes, prices will continue to soften, but they can withstand that. They can absorb prices in the mid to high 50s for, let's say, 6 to 9 months from now onwards, as long as there's light at the end of the tunnel. And if prices start to creep up back into the early 60s by the end of 2026, and they're on a growth trajectory because OPEC markets are starting to tighten because non-OPEC plus supply is starting to not grow at the same pace that we have seen, and
But I
the
think
industry focus comes onto that absence of a spare capacity buffer. That's really the game plan that they have.
My question, really, a follow-up is where is this more of a internal OPEC plus question rather than external? At the end of the day, this is a group of 20 plus countries. Very few of them, even if you gave them $1 million, couldn't increase their supply tomorrow. And yet we are in this sort of so-called supply increase strategy. How does that stay aligned? What's your thoughts on how much road is left in that?
There's an element of cleaning house at the moment, I think. As you say, that the more that these quotas get increased, the more it becomes apparent that so many members, even within this kind of elite group of 8 element within OPEC Plus, just don't have the capacity that has been assigned to them. That's been a problem for a long time for OPEC Plus, is that what they have on paper doesn't match what they're able to do in reality. And so everybody does these complicated mathematical equations to work out, actually, they're saying they're increasing by 1.5 million barrels a day. Let's say that's only 600,000 on paper. That's a problem for OPEC. So now that we're starting to get a really more accurate view of what capacity genuinely is, they're looking to roll out new production baselines and therefore quotas that can be set out of that from January 2027 onwards. And that will really help with the market management going forward. So I think that, again, they're willing to absorb a little bit of a tough end to 2025, tough start to 2026 as a result of that strategy, but it puts them in a much better place going forwards.
Daniel, when we drill down into the regionals situation where the slowdown in government spending, I mean, you say Saudi still looking relatively positive, but there's been significant announcements of government spending projects being curtailed. Where does that trickle into the regional economy? How immune? You're giving quite a bullish outlook there, but the history of time has showed $10 off the barrel each year, and that's been the case now for 2 or 3 years. This region feels gets impacted. Are you saying we've now moved beyond that? We're in a new era?
To a degree, I think there has been a concerted effort, clearly as part of the diversification plans. They want to get away from the kind of pro-cyclical spending. They don't want necessarily their growth cycles to be dictated by the vagaries of the oil prices. And that is clearly a very difficult thing to do in this region. I suppose
a bit like OPEC, every country's different. I mean, Oman is different to UAE in that sense.
Yes, of course. And, there has been progress in terms of diversification. It's not... We just had the IMF upgrade the region, the GCC in particular, with its latest World Economic Outlook, in large part on the back of the higher oil production as these oil production curves are eased. But when you look at non-oil activity, it's really pretty strong. And a lot of that is being driven by this high level of government spending. Clearly, there is a lot of project activity. And when we look at the figures on that, a lot of it has already been awarded. So we would see the greater risk to this kind of in the longer term. In the near term, we still, as I say, pretty positive. Lots of big infrastructure projects, UAE, Saudi, which are already in play. But when you look at other data as well, the private consumption data is also very strong. And you look at the GDP figures for Saudi Arabia, for the UAE, it's these consumer-facing sectors which are also performing very well. And we're seeing high levels of population growth, high levels of kind of point of sales activity growth. Everything is pretty robust. Inflation's coming down. So yeah, there is a risk. Clearly, it's still the
What about
GCC.
weak dollar, low price? These synergies at the same time, not an issue?
Well, when you look at inflation, for instance, obviously the dollar has weakened against the major currencies. When you look at its performance against some of the key regional trading partners from which imports would be coming, then that inflationary pressure isn't there to the same degree. So I don't think that is as much a risk. And on the flip side, it will make exports, in particular tourism or services exports, more attractive as well. Clearly, the UAE in particular has become a pretty expensive place to visit for many of the key source markets. And with that weaker dollar, that's going to be a boost. And we're seeing, I think visitor numbers are up around 5% year on year this year in UAE. That follows pretty robust double-digit growth for the past several years. So that is another key supporter. And likewise in Saudi Arabia, tourism, both domestic and international, is really growing very strongly. So yeah, lower oil prices, we can't discount it. Clearly, that is a risk, but I don't think perhaps a greater risk as it has been in the past. There has been some progress on these diversification efforts. And as we were speaking about a moment ago, the commitment to borrowing to continue the activity growth is something a bit different as well.
Let's go to the survey question, which is going back to where we started out our conversation. Would the collapse of Gaza's ceasefire be bullish or bearish for oil prices? I mean, if it's one thing that its announcement may or may not have been relevant to oil prices, but would the opposite be the same? A collapse in the Gaza ceasefire be bullish or bearish or indeed irrelevant, which it seemed to have been on the announcement of the ceasefire, somewhat irrelevant. Would it be the same in the reverse, as we're seeing already today and yesterday, stresses about implementation, and we're only at step 1 of 20 steps of this ceasefire agreement. So that's a question that probably needs a little bit of thinking. Something a little bit more easier would be Mike McGlone's Bitcoin Gold, maybe at the forefront of a great reset post note yesterday to all of your clients. I was quite intrigued by that. I wanted just to get your get a kind of a verbal understanding of your point here, Mike. The idea that gold and Bitcoin are separating, this idea that Bitcoin is taking a bigger hit in this uncertain time, gold is showing its true form. What's your insights there?
There's potentially a big bait and switch going on in the Bitcoin space. The insiders, the tech geeks, the people who got it a long time ago and bought it at very cheap levels are now kind of selling it out to the masses who are buying it via ETFs. And it's one of the best leading indicators I've seen. I mean, I started really watching it 10, 15 years ago. And the key significance of right now, Bitcoin gold is right about 26 ounces of gold per 1 Bitcoin. The high for this year was around 38. It's starting to head lower. It's a great leading indicator. And it's ticking lower. So I'm curious, I'm concerned that this whole space that had one cryptocurrency in 2009 and now has 25 million based on CoinMarketCap is going to succumb to the normal supply-demand rules of life, that you go lower when you have excess supply and excess hubris and excess speculation. And to
A bit
me,
like
the
Tesla
potential
and BYD and other EVs coming to the market.
Yeah, well, it's the technology is amazing. That deflation coming out of China is significant. But also, if you get a little more deflation in cryptocurrencies, which I'm concerned about the end of the year, that's going to trickle down everything. And I think potentially it has basically about a 1929-ish type feel in the cryptocurrencies. The end of this year could be quite harsh, I think, as people realize that they have numbers on the screen. At least the number on the screen of crude oil backs something. In the cryptocurrencies, there's only 300 million, a billion of backing. Those are stable coins, crypto dollars. The rest are just speculative digital. It's great to speculate, but speculative digital assets. And I'm afraid it's going to lead this potential recession in the back of one key thing, the U.S. stock market going down. Because right now, at 2.3 times GDP in the U.S., that's all that matters. That the stock market is the economy, and cryptos are great leading indicators of speculation.
Jamie, the supply opportunity for OPEC Plus in terms of where it's, the physical, the idea that there was recently meeting in Vienna about sort of establishing new baselines, the idea that this period increased supply to see who's who can do what, and then you readjust the baselines to then be the reference point for what it is a new era, if you like, for OPEC Plus. This post-COVID crisis management is over. Now we need a new baseline for the next mountain to climb. Are we seeing any notable new sort of clarity on that? Is there any, oh my God, I didn't know that, Nigeria could only produce 100 barrels? Or, is there any shocking, or is there anything sort of fundamental changing or emerging yet in that space for a new baseline?
Not yet, quite frankly, Sean. At the moment, the play does appear to be let's increase the quote. Let's ease the production cuts. Everybody's quota increases, and then we start to see who's able to keep up and who isn't. So obviously, the vast majority of OPEC Plus countries are not subject to any voluntary production cuts at the moment. We should have a pretty good idea of where their capacity lies. Nigeria, you cited, yeah, they've managed to have some successes this year in increasing production, actually. So they will certainly be selling that hard within the Secretariat. It's a lovely idea. This idea that we can have more of a technocratic solution to this. Production cuts are based entirely on everybody's capacity, and these are independently assessed. Beautiful idea. How realistic it is, I'm not 100% sure, because OPEC, as you're very well aware, for decades, the production cut agreements there's been a lot of compromise on there. There's been a lot of politics in there in terms of face saving that countries want to be on a level playing field with someone else. They don't want to admit to having a lower quota, and that's how you tend to get these deals across the line. If we just go solely on a meritocratic basis, I'm not sure how many countries will quite frankly sign up to that. It could be quite embarrassing for some of them. Compromise is an essential part of any agreement, and if we just go strictly on a technocratic basis, yeah, I don't see that working necessarily. But we'll see. It's definitely a good initiative. It's something that it's good to see that they're trying this.
Daniel, last word with you on the Fed. We've, as I said earlier, Jay Powell came out yesterday, sort of signaling more rate cuts are coming. Where does Emirates NBD see that play, that dot plot or whatever might be the forecasting? Because you have this lag of the trade war still to deliver inflationary pressures upwards. But what's the outlook from Emirates NBD on rates and what its ramifications for this region are? Because of course we're tied to that.
Yeah, so I mean, I think we're pretty much in line with consensus, expecting 2 more this year and 3
2?
next.
Whoa.
Yeah, two more this year.
Mid-October.
So, obviously there is inflation risk still from tariffs. It hasn't really materialized yet, though. I'm still waiting to see any real impact. I think it's still really services, which is the key driver of that faster price growth. Obviously, there is a risk that suddenly businesses will be forced to pass all these on. It'll come very hard and fast. But at the time being, and the comments from Jerome Powell last night back this up, he's become far less equivocal than he had been for quite some time previously. It's clearly now the labour market which is at the forefront of concerns, not to the extent that we're going to have to see kind of 50 basis point cuts. I guess Stephen Myron will continue to vote for these. But the fact we only had the one dissension last time, I think makes that unlikely. I think it's going to be a far more gradual process. For the region, clearly lower rates, will that give a boost to private consumption? It can only be a positive, I guess, bring down borrowing costs for businesses and for home borrowers. But the impact isn't as great as it might be in some other economies, not least because the high proportion of cash buyers in the housing market here.
Mike, I meant to ask you, I forgot, and just reminded there with Daniel's comments. When does the Fed, or not the Fed, the Treasury or the Trump make announcements about the new Fed chair? That's coming up pretty soon in the new year, isn't it?
Yeah, Chairman Powell's term is until through May. As far as making announcements, that's one thing that the gold market loves. Is President Trump, certainly when he pushes back into things that make America great, like the separation of the Federal Reserve from the president. But one thing that's happening with this shutdown, which he says is a good thing, it's bringing one thing out that he really wanted: Fed rate cuts. So they're expected to cut 25 basis points at the next 3 meetings, and that didn't really happen for the shutdown. So he's getting what he wants. The shutdown's helping it, and he's getting lower prices. He's getting Fed easing, And the thing is, one thing that our senior economist Anna Wong pointed out, this government shutdown is significantly a potentially recessionary factor. So he might get that too, unfortunately.
Well, it seems that every day is a new day to buy gold. Irrelevant versus bullish. That's the view here. It's certainly not bearish, I suppose. But nonetheless, that was the trick question. Thank you, guys. Really appreciate your insights today. And greetings to Mike, to the evening in Florida. Thank you for staying up with us. Jamie in London, up early. Thank you so much. Daniel Richards, living the life here at normal times, 10:30, 11 in the morning. All the best. Catch up with you soon. Thank you.
See you soon. Bye.